Analysts are expecting a big year for energy stocks in 2025 as these companies work to keep up with all the growth in AI.
One area of the stock market in which is projected to have a lot of growth in 2025 is the energy sector. In this video, we're going to be analysing two of the key stocks mentioned on the Market Beat channel by the analyst Marc Lichtenfeld. So without further ado, I will show you this video, and then from there we will start analysing these stocks to see whether or not they are key investments for 2025.
So you just released a new report really talking about the one factor that could slow down all of the explosive growth we've been seeing in AI, and that is energy and the demand on the system. Will you share a little bit about the research that you've done?
As you may know, AI just requires enormous amounts of energy. For example, a simple chat GPT query requires 10 to 25 times more energy than a simple Google search. The draw on energy, the requirements for energy from AI are astronomical. Elon Musk has said that the next shortage in the United States is going to be electricity. Donald Trump has said that because of AI, we need twice the amount of electricity that we have. In order to have electricity, you need something to fuel it. So to me, energy is the very obvious story for 2025.
Some specific energy stocks that you can see doing really, really well in 2025.
So in the natural gas space, I have two. One is, you're not supposed to have favorite stocks, but this is kind of one of my favorites. It's been for a long time. Enterprise Products Partners, ticker symbol is EPD. This is a master limited partnership, and they transport natural gas throughout the country. As long as companies are transporting natural gas, much of it will have to go through Enterprise's pipelines, and they just collect a fee along the way. There's not a lot of capital that's required to run the business. Basically, they just have to maintain these pipelines, and it pays almost a 7% yield. They've been raising the dividend every year for, I think, about 24, 25 years now. And it's just a real steady performer year after year. The other natural gas company I really like is Cheniere Energy Partners. So not Cheniere Energy. Cheniere Energy is, the ticker symbol is LNG. This is Cheniere Energy Partners, also a master limited partnership, and the ticker symbol is CQP. And the reason I like it is they have one of the largest natural gas terminals in the country. They store gas, they transport gas, and they have shipping maritime terminals where they can export the gas, which is going to be a bigger and bigger part of the natural gas business in the U.S. going forward. Donald Trump is very much in favor of exporting gas. And let's not forget, Europe has been importing a lot of gas from Russia. And I think they're kind of getting over that. They don't want to be held hostage by Russia. Be able to import American natural gas is going to become more and more attractive to Europe, and that should definitely benefit Cheniere Partners. Cheniere Partners also has about a 6% yield versus the regular Cheniere Energy, which has a much, much lower yield. And with a master limited partnership, your dividends are tax deferred. So you have the tax advantage along with the higher yield.
With that being said, we're now going to do a quick check on EPD. We're going to look at the financials to see whether or not this stock is undervalued. It is important to note that these stocks are not going to exponentially grow massively in 2025. I think on the very, very high end, you will see a return of potentially anywhere between 20 and 50%, and that is the very, very high end with stocks like these, as they are very sustainable and stable stocks. So with that being said, let's take a look at my system to see what it thinks about this stock. Starting off on a bad note, we're looking at the liquidity ratio here. We're converting the liquid cash to the total debt, and we are well below zero here. It's actually so below zero that my system wouldn't even compute it for some reason, but it is not good. What is the reason for this bad liquidity ratio? So this could be due to a high capital expenditure in the energy sector. The energy and pipeline industry often requires substantial capital investment in infrastructure, pipelines, storage and processing facilities. So that could definitely be a big reason for this lack in liquid cash to debt ratio. Another leading factor towards this could be a master limited partnership structure. EPD is required to distribute a significant portion of its earnings to unit holders or investors, as it does pay out a large dividend of around 6.6%. This reducing the cash on hand to pay down debt for reinvestment in the business. I think that those two factors alone do actually equate for this lack in liquid cash. So with that being said, we're now going to move on to the retention rate for this company. Looking on here, we can see this is relatively strong, with it around 10%. Furthermore, trend lines do actually expect this to increase, so I think this is perfectly stable, nothing to be worried about here. Now we're going to look at the free cash flow. This shows the operating to free cash flow on these charts here. Looking at the free cash flow alone here, we can see that this is really strong. It is decreasing slightly, but the trend lines are projecting this to increase again. I wouldn't be too worried about this, as again, free cash flow can be used for paying out debt, paying down dividends, or stock buyback, so nothing to worry about here. Again, very strong. And now when we take a look at the exponential charts on a 365-day basis and a 91-day basis, on the top here, looking at the price, we can see that this is actually projected to go up in the next 90 days, so I'm not particularly worried about this. Again, it's not going to be a massive increase because of the sort of stock this is, but we are actually above the trend line slightly, as you can see there on the 365-day moving average. Furthermore, we can see that these two trend lines are actually pushing against each other, which is another bullish indicator for this stock. And now looking at the 91-day moving averages, it is a similar story again. Nothing to worry about here at all. So now we will look at whether or not this is a buy or sell according to Graham's formula. On the left we have a more bullish formula, and on the right a more bearish revised formula. On the left we can see an intrinsic value of $55, with the current price being at $31 and a margin of safety at 75%. This gives us an acceptable buy price of $41, putting this stock at a buy. If we jump over to the right chart here, we can see that the intrinsic value is set at $34, which is just above the current price, with a margin of safety at 75. Again, this puts an acceptable buy price at $25. This is assuming that the analyst growth rate of 7.12% in the next year is right. Despite this, when I actually up it to 10%, we still get a similar story, with the acceptable buy price on the right being just below where we currently are. So I think with that being said and kept in mind, I do think this stock is fairly valued currently. I do think that we will see growth in the stock, so it is definitely a stable investment. To further back up this opinion, looking at the Lynch value here, we can see a result of 0.8, which means that we are slightly overvalued currently, but this is a very bearish indicator, and I do think that this stock is fairly valued currently. Looking on TradingView here at EPD, we can see that we are well above the 200 and 100-day moving averages. With the RSI being at 54, it is pretty standard currently. And looking at the MACD ratio here, it currently puts this stock at a short, with this crossing over positions here. So currently I would go off of this and say it is a short. These short positions don't particularly last long, as we can see here with this stock. It's not volatile because there's not a lot of shares being traded, but there is definitely a lot of mixed opinions within the market with this stock. I don't know how long this short position will cross over for. It will be interesting to see, of course, but personally I won't be buying in until that swaps over again. So that is enough of EPD. A quick overview of this stock again. My conclusion, is I think it is a great stock. I think we will see this grow in 2025. It is definitely a stable investment for sure. Are you going to see massive gains off of this stock? Absolutely not. But you are set to see gains from the stock for sure. So with that being said, let's now move on to the next stock in which he mentioned in the video. Now we have moved on to CQP, keeping this as brief as possible as I don't want to waste your time. It's the same story with the liquidity ratio again. One place in which this company does definitely differ from the other is the retention, with them boasting 30.9% in the last quarter. This is due to the fact that this company does actually sell its product, as it does have the largest gas terminal. This will be useful if, say, for example, as they mentioned in the video, if the Europeans do end up buying more American gas. Now, having a look at the free cash flow, it's a very similar story to the other stock. Again, relatively positive. This will be used for paying out the dividends, in which they pay a dividend of around 6.25%. Very similar story here on the 365-day exponential chart. It's looking relatively good for a bit of growth in 2025. And on the 91-day moving averages, on the exponential chart here, we can actually see that we are just below the moving average and positioned for more growth potentially. So looking at the formulas again, on the left here, on the more bullish formula, we've got an intrinsic value of 81 with the margin of safety at 75%. We get the acceptable buy price of $61. This giving you a potential upside of around 30%. On the right here, we can see that the intrinsic value is at $52.62. With the current buy price at 55 and a margin of safety at 75%, this gives you an acceptable buy price at $39. But when we look at the intrinsic value compared to the current price, there is really not a massive amount of difference there. So I would say that this stock is fairly valued. However, the Peter Lynch formula will definitely disagree here. As stated here, we've got a result of 0.45, which gives us a heavily overvalued territory for this stock. And now looking at the buy-in prospects for this stock, we narrowly avoided here, as you can see, the MACD indicator reversing into a short position. It is currently indicating long, but because we narrowly just avoided it there, it's definitely not a long position. In fact, this would be if I was holding this stock right now, I would definitely be putting a stop loss in place. But that does not mean to say that this stock is going to have a bad year. If anything, I think it's still going to have a very good year. As he said in the video, with the likes of Trump getting in office, I think that we might see more European states buying American energy, and companies such as this will take the profit from that. So that concludes this video. I think both stocks have high growth potential in 2025, obviously not as high as other stocks in which I have spoken about. If you do want to see them, please do click on my playlist where I mention these stocks. But for sure, they are definitely strong, stable stocks, something worth considering if you're in it for a long run. So I hope you have enjoyed this video. If you could leave a like and subscribe, it would be greatly appreciated. Let me know what you think about these two stocks in the comments below, and I'll see you for the next one.